Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. Markets grinded higher this last week, with the S&P 500 gaining plus 1% and outperforming the Russell 2000. Defensive sectors such as utilities, healthcare, and real estate outperformed, while technology remained flat. Factor returns favored equal weight, value, and low volatility, signaling broader participation after growth and momentum led in Q2. International equities outperformed U.S. markets, with developed markets outperforming emerging. Treasury yields declined, particularly in the intermediate portion of the yield curve, and high yield bonds performed in line with investment grade bonds as credit spreads tightened. FX and commodities were mixed. Gold ended flat, oil traded sideways, and USD weakened. The VX fell to a 2025 low, reflecting investor confidence amid improving breadth, better than expected earnings, and progress on trade policy. Key takeaways: 1. Housing activity remains sluggish. Building permits were flat compared to May, 0.2% but fell 4.4% year over year. Single family permits fell 3.7% signaling weak construction activity ahead. Housing starts rose 4.6% primarily driven by the volatile multifamily category, plus 30.6% while single family fell 4.6% Existing home sales dropped 2.7% to a 9-month low as 30-year mortgage rates hovered near 6.8%. Housing inventory continues to rise, but prices reached a record high in June as rate-locked homeowners remain reluctant to sell. Implication: residential construction is likely to have subtracted from GDP in Q2, and high mortgage rates and soft single-family activity point to continued weakness. 2. There was progress on trade policy this week. Japan struck a deal with the U.S., agreeing to a flat 15% tariff on autos and most exports while committing up to $550 billion in U.S. supply chain investments. The agreement helped Tokyo avoid a steeper 30% Liberation Day tariff and marked a breakthrough in the Trump administration's trade policy. Attention now shifts to the EU, where talks are underway to secure an agreement before the 8/1 deadline. Implication: the Japan deal removed a tail risk and sparked a relief rally, but the real test comes with the EU. An agreement could establish 15% as the global norm, but a breakdown could reignite tariff anxiety. 3. With about 30% of S&P 500 companies reporting Q2 results, earnings are off to a stronger than expected start. Over 80% have beaten estimates, lifting blended EPS growth to 6 to 7% from 4.8% at June's end. Financials are delivering the biggest surprises, with banks reporting vigorous trading and deal activity. Alphabet's results and CapEx outlook reinforce the AI investment theme, while tariff impacts are prompting negative guidance revisions at companies such as General Motors and Mattel. Implication: the bar was low heading into earnings season, and companies are clearing it. However, 6 to 7% EPS growth would still mark the slowest pace since late 2023. 4. Meme stock fever returned this week as retail traders targeted heavily shorted names, including Opendoor, Kohl's, Krispy Kreme, and GoPro. The stocks registered intraday gains of 25% to 100%, fueled by high short interest, thin floats, and viral social media buzz. Implication: the resurgence of meme stock trading signals a revival in retail risk appetite, similar to that seen in 2021. With the S&P 500 and NASDAQ trading at record highs and trade tensions easing, risk appetite has spilled into lottery ticket corners of the market. 5. Next week's calendar is packed. The main event is the Fed's 7:30 meeting, where the central bank must balance inflation risk against signs of slowing economic growth. A wave of top-tier data surrounds the Fed meeting, with Q2 GDP, the Employment Cost Index, and PCE inflation offering fresh insight into economic growth, wages, and price pressures. The week ends with July payrolls and the ISM Manufacturing Index, while tech earnings from Microsoft, Meta, Apple, and Amazon will be analyzed for clues about AI capital expenditures. Implication: next week touches on all the macro themes the market cares about: economic growth, inflation, labor market momentum, and AI earnings. The results could either support the current market narrative, resilient economy, AI growth, and sticky inflation, or challenge it, potentially triggering a market repricing. Stay calm, stay invested, and let us know if we can help. Visit MRAadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website